I don't think that 2.9 or 3% in the 10-year yield is enough to hurt the stock market. But a rising dollar and rising rates in general are negatives for the commodity sector and for names related to the commodity sector. And that's what we want to do next. So this picture, keep in mind, a rising dollar getting to key levels, pushing up, and rising interest rates will have an impact on gold. All right, so let me put this over here. So this is the chart of the GLD daily. Goes back to June of 09 when the GLD was 93. GLD peaked at an all-time high at 139.15 on November 9th. November 9th was slightly beyond the peaks in both the dollar, or the trough in the dollar on November 4th, and the peak in the bond market November 4th. So the GLD had this one more lift. Now, within this channel, the GLD from its July 28th low at 113.08 to the November 9th high at 139.15. Look at what happened. The momentum shows that the peak of momentum, the high of this move, the July-November move, in terms of momentum occurred at this high, 134.85. Pullback, and this green line right here is the 20-day MA. That's the 50-day is the red, and the 200-day is the light blue. So you had a beautiful pullback, held the 20-day where it held all along, and rocketed to new highs about a week ago. Right? Now, look at momentum a week ago. Much lower momentum. So I knew that there was a setup here that possibly, if the technicals worked the way they traditionally work, you had a giant momentum non-confirmation of a new high in price, and that should be a major warning sign that the GLD is in trouble, or the GLD is vulnerable to a major shakeout. So let's draw in this trend line right in here, and we can see that the decline so far from last week's high at 139.15 to today's low, or last, at 132.40, has closed today leaning against this trend line. And if it breaks, there's a gap here that needs to be filled down into the 129, 90, 70, 50 area. Somewhere in there. The 50-day MA is 129.70. And if that area breaks, which is key support in here, the key support zone for the GLD is really 129.70 to 129. And if it breaks, then chances are this channel will be the demarcation lines, will provide the demarcation lines of where the GLD will go next. So, a break of the 50-day MA in this area, 129.70, 129.30, argues for a complete traverse of the major channel that goes all the way back to April 09. And if that happens, the GLD will come into somewhere around 123, 124. The high of the February June rally in the GLD was 123.50. So the channel and the prior support, that is, it was prior resistance, now support, it all comes in about the same place, 123.50. So that's where the GLD looks like it could be headed. Now, why would it do that? Well, we already discussed it. This is why, which is the relationship between the dollar and the bond market. They're moving towards each other in terms of price, and that is a negative for the GLD. So let's go to another chart that's very important here, the GDX, because the GDX mimic gold, obviously, also had the benefit of the stock market rally going for it, and has held up better than the GLD for the most part, because the stock market has held up better than the GLD, because the GLD is subject to the dollar situation. So the momentum in the GDX peaked the same day as the price, which is a different situation, which was November 9th. The GDX peaked at 63.76 right here. And momentum peaked on the same day. That's a different situation than gold, than the GLD. So right now, from a momentum perspective, the GDX exhibits better internals from the perspective of price momentum relationships than does the GLD. So let's keep that in mind. Now, is it immune? Is the GDX immune from gold, the behavior of gold, or is it immune to the dollar, the strengthening dollar? No, not at all. But it is a sector of the stock market, and if the stock market holds up relatively well, then it's conceivable that the commodity side outperforms on the downside, and the stock side of the gold mining situation outperforms in a positive sense on the upside. That is to say, it falls less, and then when the market turns around after a pullback, I think the gold mining sector may not be the leaders. In fact, I think probably the financials will lead, but they will go up, but it will go up to the GDX and the mining sector. Now, what do we have here? There's a big island up here. So, in other words, on this day right here, which was the 4th, what a coincidence. The 4th, the GDX gapped up and left behind, separated its price action from the night before, which would have been the 3rd, I guess. So the high on the 3rd was 57.84, and the low of the subsequent days was about 59. So there's a gap here of about a dollar and a half, and it looks like, based on the close tonight, with the GDX leaning against this key support area at 59, that it could gap down, and if it does, it leaves this island cluster up here, which is a fancy way of saying a group of days or several days where it trades all above an original up gap, and this may turn out to be an exhaustion gap. It certainly looks like it, and if it is and it gaps down, then it will leave an island cluster of days up here, separated by a gap up on November 4th, separated by a potential gap down, let's say on November 16th or 17th. Now, the gap can always be filled and the island goes away, but for the time being, a gap down leaving an island cluster is a pretty negative indication. Where can it go, or where would the GDX likely go? It would come down and test this trend line created off of the July-November trend line, and that would be probably somewhere in the vicinity of 55.5, 55.60, 55 even. Now, see this horizontal line in the GDX? That's the line across all the highs, starting with the March 2008 high. So if I scroll back here, you can see this was the March 2008 high, somewhere around 56.74. This high was December of 09 at 55.40.